soon to appear Dimitri Pargamonik. Morning, Dima.
Good morning, Will. How are you?
Awesome. So I put the link into the YouTube chat for the Zoom meeting. Any questions you have on today's episode, just come on over and ask them live. If you weren't on yesterday's show, Jake came on live and it led to an interesting discussion, which is going to carry over today. And that's the advantage of doing things live. So that link is in the chat. With that, you want to start with the disclaimer, D? What do you think?
Yep. And if Jake is here, that question kind of came up all the way at the end of the show. So if Jake wants to come on, maybe ask the question again. And I could just walk through the example we were doing yesterday. And this way, if there are any follow-up questions, I'll be glad to answer them today. And if anybody else wants to come on live, ask a question, sometimes that's easier than just typing it in. You're welcome to do that. Click on that link, and then you could ask the question, and I'll try to go through an example and answer the question. So before we do get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right.
All right, let me share my screen. And what we'll do is we'll start out looking at the pre-market report. After that, I'm going to go into a discussion about option early exercise. And I think that's where the question was headed yesterday at the end of the show. Jake, kind of, when we were doing an example of a call time spread, I think Jake was saying, well, you got to be careful because there is an early exercise risk due to an ex-dividend. That's where I think he was heading. If not, Jake, come on the show and maybe then you could clarify it. But right now I'm going to go under that assumption and discuss that risk and how to navigate or handle the early exercise risk. Okay. So before we get to that, let's just take a quick look what's going on today in the pre-market hours. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here real quick, take a look at how many made our percentage gainers list. Looks like 75 stocks on our percentage gainers list, 52 on the percentage decliners. So slightly more favorable towards the bullish side at the opening. Let's filter out the higher market cap stocks, see what's going on there. So I'm using this filter, higher market cap, $20 billion or higher. And here we see 12 made the percentage gainers list, 22 in a percentage decliners list. So from that perspective, it looks like it's going the other way, and it's more of a slightly bearish bias at the open than bullish. And the list isn't huge. They're not a ton of stuff, but nevertheless, a little bit more bearish bias at the open if we're looking at it from the higher market cap stocks point of view. Okay, if there are no questions, I'll try to go then to an example of option early exercise.
Yeah, you can move on, D.
Okay, and I think what led to it was yesterday we were looking at a stock. We started looking at big open interest. I believe it was this stock ACRE. And when we're looking at the options, we went over an example where there was a big open interest increase. I believe it was in might have been like here in the Feb 22 expiration. I'm going to look at the open interest here. So it was in the 17.5 calls. There's a big open interest increase relative to the stock. Okay, so we do things based on relativity. This would not be a big open interest increase in SPY, but for ACRE, we usually don't see that in one day. And then we took a look at the trading, and we thought, well, if we participated on one of the trades, one side of the trade, what's a possible way to hedge it off? So we went here and kind of took a look at it, creating a time spread by selling a near-term option. We talked about a call versus buying a longer dated option, another call. And Jake came on the show and said, well, you got to kind of be careful because when you're selling a call, when you're selling a call, a stock pays a dividend. And here we see that this is a REIT, it pays a dividend. Here we're estimating 2 cents, so it's not a really big dividend. So I'm going to use a different stock as an example where the dividend is larger. But whenever you're trading options with early exercise, right? What does that mean? Early exercise, that means that if you own the option, either a call or a put, you have the right to exercise it before it expires and convert it to stock. So if you exercise it, that means you're exercising a call, you're long a call, you're going to convert it to stock at the strike price, and then you own the stock, the option goes away. All right, so you no longer have the option, you exercised your right, and now you have the stock. Same thing with the put. If you own a put, you have the right to exercise it before expiration. And if you exercise it, what happens is you short the stock at the strike price, and then that put no longer exists. That's the contract's over because you exercised your right. Now, when it comes to dividends, okay, there are times you want to exercise your call. There are times you're going to want to exercise your put. And the model assumes that you're taking the appropriate action at the appropriate time. So one of the things Jake's saying, there's a warning, because you can get an exercise, you're going to end up paying the dividend. And if you're not doing the right things, you're going to end up potentially either leaving money on the table or losing money, because based on the options model, based on the option prices, they're assuming you're going to take the appropriate action at the appropriate time. Okay, so you have to know how to do that. Whether you're short or you're long, it's assuming that you're either hedging it the right way, or you're using the options the correct way to minimize your losses, maximize your gains. Okay. And with the call, when we talk about a call, okay, and I think Jake said, okay, option prices are pricing in a dividend. They are pricing in a dividend, but they're also pricing in the early exercise component, meaning that if you do nothing, right? If you do nothing, then you're going to leave money on the table, because it's assuming that you're going to use the early exercise component appropriately. And that's the important part. So if you're looking at it, if you're looking at your position, it's very important prior to the X date that you look at your position and you manage it correctly. All right. A put, I'm not going to get into unless I have time. That's also the case, but I'll just talk about the ex-dividend today. So since this is a small dividend, I'm just going to kind of go over something maybe a little bit larger. And this is why we have a dividend calendar. Our watch list has ex-dividend dates, because ex-dividend dates become important. It's almost like an event in options. And I'm going to come here under stocks, and we're going to go under calendar. This is the ex-dividend calendar. This is today's ex-dividends. So we see here up top, Procter & Gamble, ex-dividend today, 86, almost 87 cents that they pay quarterly. So the important thing to understand about ex-dividend dates is if you take an action to manage your position, you got to do it the day prior to ex-dividend. So today, it's trading ex-dividend, means the dividend has been already taken out, it's over. So there's nothing you could do about it today. You can't buy the stock today and get the dividend. It's over. It's trading ex-dividend. So if you wanted the dividend, you needed to take action the day prior to it. Okay. So today, you could see here that Procter & Gamble, it's down today, but the stock would have been reflected for this ex-dividend. All right, so that's important. Anything you do for the dividend, you got to do it the day prior. And let me know if you have any questions, Will, about that. So if you have options in a position, you need to look at, if you want to take action today, you got to look at it prior. So July 23rd, now I'm looking at tomorrow's ex-dividends to make sure if I have any options in there. I need to take some action. I got to look at my positions and make sure I'm taking the appropriate action, prior to the ex-dividend date. So that's important to know the time, the dates. So let's take a look at Procter & Gamble and see, well, if we were looking on the board, what would we do prior to the ex-dividend? Okay, so I'm going to Procter & Gamble right now. And I'm just going to look at the options chain here, right? I see this is yesterday's options chain. We didn't open up yesterday, so this is as of yesterday's close. And I'm going to look first at what would be exercisable, okay? And when you think about a dividend, a regular dividend, okay, not a special dividend, not maybe a special corporate actions, but a regular dividend is not a call owner is not entitled to a regular dividend because you don't own shares of the stock. You just own the right to buy shares. So the only people who get the dividend are the people who own the stock, and you got to own it prior to the ex-dividend date. Okay. So for example, here's a 105 call. This is deep in the money call. It's about, like, let's say $34, $35 call. And since it's deep in the money, I'll even go out further, right? Very deep in money. Let's say 100 call. That's easier to look at. Let's say I own a call that's on the $100 strike and the stock is 139.20, right? With 2 days to go. So since this is very deep in the money, the option price will move 1 for 1 with the stock price. So if the stock goes up $1, this option goes up $1. If the stock goes down $1, this option is expected to go down $1. If it goes up $5, the stock goes up $5, the option will go up $5. And then the reverse. So essentially, my call has no premium left. There's no more decay because you could see that the bid is below the stock price, right? So 138.80 plus 100 is $138.80. The stock is 139.20. So I can't sell this call and collect any premium, right? Because if I sell this call at 38.80, that's worse than just exercising the call and selling the stock. Because if I exercise the call, I could sell the stock at 139.20, right? I buy this stock at 100 and I sell it at 139.20. But if I sell the call, I only get 38.80. So this is no time premium left in this option. So I can't sell it and get any time premium. And it moves around just like the stock. So what do I do here if I own the call? Well, I know that if I hold the call, I'm not going to get this 89 cents, right? I'm just not going to get this 87 cents. I'm not entitled to it. So to get that 87 cents, I have to exercise my call, convert it to stock. Once I have the stock, then I get my 87 cents. And if the stock goes up or down the next day, I have the same risk profile anyway, holding the call, right? So why would I give up that 87 cents? If the stock's down $1 tomorrow, I'm going to lose $1 on this call anyway, right? So I'm out of that 87 cents. So based on this, based on this call, the right course of action is to exercise and get that 87 cents. That's your right? That you actually paid for that right when you first executed that option, because it has an early exercise component. So remember, the options are price based on that early exercise. You don't, but you will not get entitled to this 87 cents. All right. You need to take action. All right. And exercise it. So does that make sense to everybody?
That makes a lot of sense, Steve. People are enjoying this conversation and this discussion. We do have someone raising their hand. Can we let the person in?
Yeah.
Another special guest stepping up, which is awesome. Here we go.
Hey, Dimitri, me again.
Hey, Jake, how's it going?
sorry for bugging you and stalking you on your daily show.
No, I enjoy it. You ask good questions. So you brought up.
Okay, the question I've got here, right? You're talking about the long side on the call, right? What if you do? If you're unfortunate and you're actually short that call? You buy the stock straight away?
Exactly. So if you manage it appropriately, the short side is actually the better side to have. Manage the correct way. So it's not unfortunate. It's actually there's an edge being shorted, not long. Okay, and I'm going to explain that. But first, I wanted to explain why you're exercising it. Okay, and if you're short it, you're going to have to assume that somebody is going to exercise it on you. So you would need to hedge that by the stock. You need to do that, or you're exposing yourself. But once you buy the stock, you actually have an edge in the long term because somebody might forget to exercise that call. And I'm going to show that example. So it's not actually in an unfortunate situation. You want to be in that situation. And actually market makers prior to that dividend, maybe you could look it up. They do dividend spreads, dividend arbitrage spreads, trying to establish the short side. And I'll explain.
But that would, the forgetting to exercise almost never happens, right? I know on interactive brokers, you put it on auto exercise and the thing's going to auto exercise. Does people actually forget?
Yes, and that's why you want. Yes, and that's where a lot of so just to give you an example, and there's lawsuits you could go through it because market makers take advantage of that because people forget and they do these dividend spreads. But there's millions of dollars of people profiting from people forgetting to exercise. Okay.
Oh wow.
Whatever they could forget, maybe they don't know they could do it but for whatever reason they forget to exercise, and then what happens is you actually earn the dividend for free if you're short the call and long the stock, right? Because once you're short the call, you buy the stock against it, you're assuming, well, if I get exercised the next day, I'm out, right? I don't have the stock anymore. The call is off the table. It's all gone, right? And I didn't pay the dividend. But if that person forgets to exercise, you get the dividend on your long stock, and wherever the stock, you're hedged with that short call, right? So that short call is hedging off that long stock, and you receive the dividend. So let's take a look at Procter & Gamble, because Procter & Gamble went ex-dividend today. So we're going to take a look if anybody forgot to exercise their call, right? So we're going to take a look today at what happened. So I'm going to go here to the open interest, right? Here's the open interest. So we see here that people were exercising, right? People exercise 124. There's no open interest. It all went down. So people exercised it. Open interest decreased. But look here, 238 of these. So this is what, looking at the 135. So that's a close one. So it looks like people did exercise it and 6 were left over. So let's see why these people exercised the 135, because that's close, right? That's not deep in the money. It's $4. I'm just going to take a look, and we're going to just try to figure out, was it a candidate for exercise? So here's how we would look. And to me, it looks like it was. It looks to me like you could almost do it up to the 138. So why was this 135 an exercise? It's only $4 in the money, right? So here's what we do. We do the check. first of all, if I own this call, can I sell it and get a premium, right? That means, can I sell it and do better than exercising it and then selling the stock? Well, here, if I sell it at $4.10, right? If I add $4.10 to 135, that's 139.10, right? But the stock is 139.20. So I'm selling it below parity. That wouldn't make sense. I'm better off exercising the call and selling it at 139.20, right? Because that's 10 cents higher than if I just sold this call out, right? So I could sell the stock 139.20, short it, exercise my call, but that's 10 cents better than just selling the call outright. So
But
that
why would you sell at the bid? Look at the spread.
Well, right now I'm looking at there's no bid. There's no bid that's high. Yes.
You've gone underwater. You're gonna have to either step away and reset your mic, or maybe log back out and come back in.
Want me to log out and come back in?
Yeah, why don't you log back? You don't have to reboot your computer. Just log out and then just come back in on a new link.
All right, let me try that.
All right. Hey, Jake, while we have you on, we did have a question from Albert. You there, Jake?
Yeah, I'm in.
Albert was asking, you mentioned you haven't you selected the auto exercise on the TWS platform, IBKR. He was asking how you do that, where exactly that's located.
That's a really good question. I think it's so top left-hand corner, you go File, and then you hit Global Configuration. And then when you do Global Configuration, you've got a ton of options in there, and it's in there. Or what you can do is you can actually go on, they've got a pretty good website, Interactive Brokers, with like a search button. So if you go onto that for help and you write auto exercise, it'll give you a step-by-step guide.
Awesome. Hopefully that helps, Albert. And if not, we'll probably be on with Jake in the next couple of weeks. You can always ask that of him then too when he's got his system up. Yeah. Maybe he can walk you through.
Yeah,
they probably have a pretty good support at Interactive Brokers as well.
Yeah, I'm on the Discord every night as well, Albert. So if you ever, you can always ask questions there as well.
Yeah, and if anyone wants that Discord link, email me, williammcbride@gmail.com, and I will send it over. Actually, after.
Hey, Will.
Hey, you're
back.
Better? Yep. Okay. Perfect.
So I think Jake's question was, why would I sell it on the bid? Is that correct, Jake?
Yeah, that's correct.
I would always try to do it higher than the bid, but I don't know if I'll be able to get it higher. I just know that I can sell it on a bid. That's a price I know I could sell it because that's a firm bid, right? That's a displayed bid. And it's not, and it's bid currently below the parity. I could try to sell it for, like, say, 430. If I try to sell it, that would be better than exercising it. But I don't know if I'll get it, right? And whenever you put something on a book like that, a limit order, you're also exposing yourself to the market moving against you, right? So if I leave it there at 430, let's say I put it out at a limit order at 430 and nobody scoops it right away, well, now I have a risk that the market moves against me. And let's say the stock goes up to 140. Well, I sold it at 430, but the market went up, right? So I still sold it below parity because the market is higher. So when you say, why would I would always try to sell it, but this is the current market that I'm trying to measure it against, right? So I know, like, for example, here, I know I could sell it at least for 31 cents, right? Here, I know I could sell it for 410. I don't know if I'll be able to sell it at 430. I could be hopeful, but there's no assurances there. Does that make sense?
I get you. Yeah, I get you.
Right. There's no assurances. I'm just looking at where the market is right now to test if this is an exercise candidate, right? And the first thing I know is if I try to sell it immediately, right, without exposing myself to the market moving against me, because if I put a limit order, the market can move against me. This is a 100 delta, option. So if I try to sell it immediately and buy my stock, right, get out of the position, I'm doing it underwater. I'm doing it under parity. So you could try before you exercise, you could try just say, immediate or cancel, 430, 450, see if somebody will take it. But I'm looking at the board right now and it's unlikely that that would happen. And I'll tell you why, because I'm comparing it to the put. Okay. So that gets to my next analysis. So this, I can't sell the call and above parity getting time premium. So if I own the stock, right? If I own the stock,
Hey, Dimitri, can you share your screen for us?
oh, hold on a second. I'm sorry. I thought I had the
No
screen.
problem. No problem.
Yeah, Will, you forgot to tell me that.
Thank God we have Jake on. I didn't see
Yeah.
it. I was typing on the YouTube.
So here we go. So right here, I'm looking at a 410 bid, right? So this is what I know right now. That's the market bid where I could go and immediately get an execution, right? As long as it's there, I get an immediate execution. That I know. Can I get it at 430? Can I get it somewhere in between 410 and 495? It's possible. I would try it, see like an immediate or cancel. I always try to get it somewhere in between, but it's not a definite. And if you leave the limit order in there, let's say I leave it at 430, well, now I'm exposed to market risk, because what happens is if the stock goes immediately to 140, I'll sell this at 430. But then again, I did the same thing. I just sold it under parity, right? Because then the stock is much higher anyway. And if the stock goes down, then I probably won't get this 410. So without, knowing that, I'm just going to assume, okay, right now I could get 410 for sure, but that's below parity. Okay. Does that make sense so far?
No problem.
Okay. So seeing this on the board and I'm trying to make a decision, I then go take a look at the put. And here's why I want to take a look at the put. If I own this call, all right, if I own this call, I could short the stock 1-for-1. Okay, so I own the 135 call. Let's say I own 1 share. I could short 100 shares of Procter & Gamble. And what I did was now I own a synthetic put. Okay, so I own a synthetic put for free, really, if there's no dividend or anything, because if the stock goes up, it doesn't matter. I'm hedged, right, 1-for-1. But if the stock crashes below 135, well, at some point this call will become worthless, but it's right now worth 410. But below 135, I keep making on my short. If the stock goes to 0, I'll lose $4.10 here, but I'll make $139.20 on my short. So I have a synthetic put here. So I have this synthetic put, but what I know here is that if I exercise the call, right, I lose my synthetic put, right? I lost it. I no longer have it because I exercised my call. It took away my short. So I gave away that synthetic put, but in return, I get this dividend of 87 cents. So basically, I sold my put for 87 cents. Okay. Well, if I sold my put for 87 cents, how much can I buy back for? And I look at the 135 put and I could buy it back for 10 cents. In other words, this is definitely based on this board and exercise. Okay. So you guys understand, if I own a synthetic put, by exercising, I'm getting rid of it. Basically, I'm selling it. But I'm gaining 87 cents. Otherwise, I'd have to pay 87 cents. So I'm gaining the 87 cents. So I'm basically selling it. I'm getting rid of it, selling it for the dividend, but I could buy it back for 10 cents.
You're getting rid of it by exercising the call, right?
Exactly. I'm getting rid of it by exercising the call.
And what, you're going to sell a 135 put on the bottom side? Is that what you're trying to do?
No, what I'm saying is, if I want my synthetic put, if I just want to be long the put, I could just buy it for 10 cents.
Okay.
Because it goes away, right? Once I exercise my call, that's it. It's done, right? I exercise my call. I have stock against it, short, so I'm done. I don't have a synthetic put anymore. I have nothing, right?
Okay.
But I don't pay. But I don't, but I did it so I don't have to pay that 87-cent dividend,
Okay.
right? And I could buy back. And if I really wanted to put, well, I could get it for 10 cents. And that's one way to look at that. Is it an early exercise? Because you got to determine, should I exercise it or not, right?
Yeah.
Same thing. If you're short this call, right? If you're short this call, well, you could buy the stock against it. So if you don't get exercise, right? If you don't get exercise, you received 87 cents on your long call and you're hedged with the option, right?
Okay.
So if it goes down $1, you're hedged with the option, but you received 87 cents into your account in addition, right? And if you wanted to hedge your downside, well, you received 87 cents. Hopefully today you could still get it for 10 cents and now you're hedged on your downside.
So awesome job, Dima and Jake. Thanks so much. It is 9:31. We're started the trading day. Hopefully those answered
Jake?
Everyone's questions. Great job, Dima.
Yeah, cool.
Yeah. What do you think, Jake? Was that helpful?
Yeah, I enjoyed it. I learned something. That's cool.
Hey, Jake, we were having a discussion, Dimitri and I, before. Were you asking about the risk reversal too? Is that something we should talk about maybe tomorrow?
Well, I was just asking why he was doing a calendar, and I was just saying, well, if you want to get that same, if you want to finance the call by shorting the front end like you've done with that time spread, why don't you just go risk reversal? And obviously, there's different risk involved with the risk reversal, right?
Yeah. So the risk reversal will have a different risk on it. So this one you could turn into an advantage if you're looking at it before ex-dividend and doing the right things. Risk reversal, your hands are more tied. Maybe I'll do that tomorrow.
You know what? Yeah, let's make that a topic for tomorrow. This was great discussion. Jake, you could be the third member of the morning show for sure. Anytime you want to come on. And listen, there were some questions. I know Mike, the mayor from Naples, had a question. I'll try to get that in front of Dimitri, maybe looked at tomorrow. Everyone is welcome to come on to the chat. It is super helpful and leads to many more questions and great answers from Dimitri. Thanks, Dima.
All right. Thanks, everyone. Thank you, Jake. Stay safe out there, everyone. Have a good trading day and hope to see you guys tomorrow.
Trade in peace, chameleons.